Good evening and a very warm welcome to Cipla's Q3 earnings call. I'm Naveen from the Investor Relations team here at Cipla. Let me draw your attention to the fact that on this call, our discussion will include certain forward-looking statements which are predictions, projections, or other estimates about future events. These estimates reflect management's current expectations of the future performance of the company. Please note that these estimates involve several risks and uncertainties, including the impact of COVID-19, that would cause our actual results to differ materially from what is expressed or implied. Cipla does not undertake any obligation to publicly update any forward-looking statement, whether as a result of new confirmations, future events, or otherwise. With that, I would like to request Kedar to take over, please.
Thank you, Naveen. Good evening to all of you and wish you a very happy new year. I hope that all of you and your families are safe and well. We appreciate you joining us today for the third quarter earnings call for FY22, and I hope you have received the investor presentation and other material that we have posted on the website. This quarter, we are pleased to report a healthy performance. For the last almost 2 years, we have been consistently beating our internal targets. We recorded revenue growth of 6%, driven by robust momentum in branded markets of India and South Africa, and continued traction in the US portfolio. Our EBITDA margin of 22.7 for the quarter tracks convincingly in terms of our full year guidance, despite cost headwinds on raw material and freight, offset by increased share of the complex and chronic launches, continued rigor on cost control and operating efficiencies. Overall, our delivery on revenue and profitability, as I said, continues to be ahead of our targets. Our One India year-on-year growth of 13% continues the impressive run, driven by sustained momentum across all businesses. Healthy order flow in the prescription business continued across all the therapies, as well as regions in the trade generics. The consumer business saw consistent uptick in core and transitional brands. The US revenue for the quarter was $150 million, one of the highest in recent quarters, led by strong traction in the respiratory and other portfolio. We have also received approval for the first 505(b)(2) version of lanreotide injection. Our South Africa private business maintains market-beating trajectory driven by steady launch momentum. The YTD EBITDA for 9 months is at 23.1% of sales, tracks quite ahead with our full year guidance. As you are aware, quarter 4 is a seasonally reverse quarter for India, and our EBITDA appropriately will respond to the change in mix. Our free cash generation and operating efficiency continues to drive our strong net cash position, despite strategic inventory build-up for maintaining adequate supply of medicines. The return on invested capital of 21.2% for trailing 12 months continues to track well above the long-term sustainable range that we had highlighted earlier. Coming to the financial performance, some of the specific highlights I would like to highlight. As expected, the revenue of contribution of COVID products at the company level was lower on year-on-year basis. The COVID portfolio declined by almost 10% on year-on-year basis and 17% sequentially. We do expect to see some traction in the coming quarters in line with the caseloads amid the ongoing third wave in India. Our emerging market business continues to maintain strong growth in DTM markets. The order flow from developed markets in our API business has witnessed a momentary slowdown, and our mix has responded accordingly. We will see traction in orders from emerging markets and API. Outlook remains robust. The total revenue for the quarter is 5,479 crores with a year-on-year growth of 6%. Gross margins stood at 60.9% on a reported basis. The marginal decline on year-on-year basis of 55 basis points and about 40 basis points on Q-on-Q basis is attributed to increase in freight and materials cost and certain provisions for the inventory, including COVID products. We expect gross margins to respond to launches from complex pipeline in the coming quarters. Total expenses, which include employee costs and others, are at 2,105 crores, declined by 2.4% on a sequential basis. Employee cost for the quarter is rupees 872 crores, which is flat on a sequential basis. Other expenses, which include R&D, regulatory, quality, manufacturing, and sales promotion, are at 1,232 crores. They declined by 3.7%, driven by strong cost control. We have retained the efficiencies from our reimagination and operational efficiency initiatives from last year, while continuing our growth-linked investments, which are driving the YY increase in other expenses. Total R&D investments for the quarter at 262 crores. All the priority project spend continue to be on track. We expect the spends to increase as the respiratory assets progress in the clinical trials. Overall reported EBITDA for the quarter is at 1,243 crores or 22.7% of sales. Tax charge is at 295 crores and the ETR is 28%. As of 31st December, our long-term debt stands at South African rand 720 million. We also have working capital loans of USD 58 million, South African rand 137 million, and Australian dollar 5 million, which act as natural hedges towards our receivables. Driven by our relentless focus on cash generation, we continue to be a net cash positive company as of December 21. We continue to be appropriately hedged for key global currencies as per our policies. Finally, just to conclude, the board at its meeting held on 25th January withdrew the scheme of the board at its meeting held on 26th October withdrew the scheme of arrangement for the proposed transfer of India-based US business undertaking to Cipla Biotech Limited and the proposed transfer of the consumer business undertaking to Cipla Health Limited in favor of a more efficient mechanism to effect the transaction. Based on management proposal, post the in-depth reevaluation, the board has approved the proposed transfer of the US business undertaking and consumer business undertaking by way of slump sale. We continue to believe that the transaction will simplify the structure, maximize the efficiency, and has the potential to unlock value for all the stakeholders of the company. To close, we saw impressive momentum across portfolio and geographies for 9 months. Growth levers in the subsequent quarters will include continued momentum across all regions, securing market share in peptide assets, lanreotide, coupled with traction in albuterol and arformoterol in US, and driving expansion in the operating profitability above FY21 base by focusing on mix improvement and operating efficiencies. I would now like to invite Umang to present the business and operational performance. Thank you.
Thank you, Kedar. I would like to wish all of you and your families safety and well-being. As COVID-19 continues to evolve across the globe with the new variants driving caseloads, we continue to ensure availability of COVID and other life-saving products. Coming to our strategic updates and operational performance for the quarter, I am proud of the strong launch and commercial momentum across our One India business with a 13% year-on-year growth and 7% year-on-year growth in our US business, underpinned by the expanding respiratory franchise. Our EBITDA margins for the quarter came in at 22.7%, as Kedar mentioned earlier, ahead of our internal targets. And given the 23.1% YTD traction, we are well placed to close the year in line with our guidance. In India, our One India strategy is witnessing remarkable traction and achieving major milestones along the journey. The One India business maintained double-digit growth momentum for the third quarter this year, coming in at 13% year-on-year. The core prescription business in India, excluding COVID, grew strongly by 16% on a year-on-year basis. The branded prescription business is on track to achieve the $1 billion mark, building a formidable franchise in our home market of India. Our customer engagement levels in our trade generic business have driven healthy orders from tier 2 and below towns in India. Some of our flagship generic brands in our trade generic business have grown past the 100 crore mark, and few others are crossing the 50 crore mark, which speaks about the brand equity in these markets. We also plan to add high growth categories like anti-diabetic and injectables to address unmet demand in the coming quarters. The branded prescription business continued the market-beating growth for the third consecutive quarter in FY22, driven by sustained traction across almost all our therapies in core portfolio. As per IQVIA Max December 21, we continue to maintain healthy ranks and market shares in our key therapy areas across respiratory, urology, anti-infective, and cardiac. Our focus continues in creating depth in anti-diabetics and the oncologic therapies, building on existing and new partnerships with global multinational corporations. The trade generics business witnessed strong demand. We've launched 10 brands across cardiac and the diabetic range this year. To further strengthen the franchise, we plan to continue this launch momentum in FY23. Coming to our consumer businesses, we are very happy to see how the business is shaped both in India and South Africa, almost contributing 8% to the company top line on a YTD basis. The India consumer business has seen robust traction in the anchor brands during the quarter, driven by high consumer recall, benefiting from the robust media campaigns and meaningful consumer insights throughout the year. Coming to North America, our U.S. generic core formulation sales for the quarter came in at $150 million, beating the previous quarter high. This $150 million mark sets a new base for our business, which hopefully will grow from these levels on the back of our upcoming launches. Our respiratory franchise continues with strong traction with 36% year-on-year growth. As per IQVIA, week ending 21st December 2021, we have close to 15.9% share of the total albuterol market and 26.8% share in the arformoterol overall market. And our shares have continued to move up from those levels, from the earlier levels. We expect the business run rate to continue to inch up further as we enter into the next year, where we also expect to show growth over the base of the current year. During the quarter, we've unlocked one major peptide asset in the US with the approval of lanreotide. We're expecting a sustainable ramp-up over the medium term. Our focus will continue to expand our peptide portfolio through internal development and partnerships, strengthening our high-value complex generic pipeline. On Advair, we remain closely engaged with the US FDA on our file, and we will continue to share the updates on the progress. On our Goa plant, we are awaiting to hear from the FDA on the inspection schedule. Coming to our SAGA region, which includes South Africa, Sub-Saharan Africa, and our Axis business, our South Africa private business reported a 16% robust growth over the last year for the quarter in local currency terms. In secondary terms, we continue to maintain market-beating growth of 9.1% versus the 8% growth overall in the private market as per IQVIA MAT November 21. In the international markets, we maintained scale close to last year's base in US dollar terms. Our DTM franchise continued to witness strong momentum across markets with steady double-digit growth in secondary terms. In FY22, we have made significant progress against our strategic priorities. We remain confident in our near to medium-term outlook, seeing the strength of our growing branded franchises and launch pipeline in the US and other markets. We have important launches in the coming quarters, and we are gearing up for these launches in the near future. We are transforming our IPD, manufacturing, supply chain, and quality operations to unlock efficiencies targeted to deliver higher performance and resilience, serving our patients more effectively. Our innovation engine seeks to capitalize on the opportunities across the healthcare ecosystem, leveraging data analytics and digital technologies to drive robust portfolio momentum and capital allocation. Our near-term priorities include continued execution on the demand levers in chronic and acute therapies, improvement in manpower productivity across our branded markets of India and South Africa, active advancement of our innovative consumer-centric products to accelerate the augmentation of our consumer wellness franchise across India and South Africa, grow our US limited competition launches footprint, including peptides, as we continue to expand both the injectable and respiratory categories in North America, focus on regulatory compliance across our manufacturing facilities and implement globally benchmarked ESG practices, and continue our high vigil on cost and cash management while driving a sustainable expansion in operating margins and the return on capital employed. I would like to thank you for your attention. Wish you and your families good health, and will request the moderator to open the session for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The first question is from the line of Nikhil from SIMPL. Please go ahead.
Am I audible?
Yes, sir.
Yeah. Hi, good evening. Congratulations on good set of numbers. I have two questions. One is, sir, if I look at our presentation where we say priorities for FY25 and in between India, South Africa and Europe and the other markets, we talk about driving sustainable growth through organic and inorganic levers. And over the last 2-3 years, we've been looking at that we've been doing tie-ups for onco or for biosimilars and these kinds of products to grow the market or presence in these markets. So just want to understand when we talk of the levers for growth, is it like these tie-ups become a very important lever for us to continue growing? Or do you think from our own organic pipeline we have product launches which can sustain the growth? Or how should we understand between these tie-ups, organic and probably inorganic acquisitions?
Thank you. I think it is a good question. I think the sources, the answer is going to depend differently for different markets. So in the US, we would like to depend on our own organic momentum of products in the US and largely EU. Our own organic momentum of products will create a sustainable base, and we augment this with few partnerships where we think the partners bring very specific technology skills which are very relevant. Right? So lanreotide is a great example of this, where we will augment for a significant product with the partnership. In India and branded markets, the case is different. In India and branded markets, though we are generic companies, all of us are almost like innovators in this market. So there we try and strike partnerships with innovator companies to bring their products even before the patent is expired. And this is important because under the patent regime in India, there will be hardly any sources of products unless innovator products are introduced into the market. And most innovators now partner with Indian pharmaceutical companies to bring these products before patents expire. So we have also partnering with these companies in India. So in the US, I think the partnership is around technology. In India, the partnership is around product source because of the patent regime. And I think both of these are important partnerships going forward.
Okay, just one thing. When we talk of India and ROW markets, we generally say that the markets, the branded generic markets are growing at something in the range of 8 to 12% depending upon the years and all. So based on these partnerships and all, so not for the near term, but for over a 3 to 5 years when you are talking about or thinking about these partnerships, is it like that incremental 2 to 3% higher growth should come from the partnerships and the rest, the market beating growth when we talk about, so that incremental growth should come through the tie-ups and rest through our organic pipeline? Just to, as an investor, if you have to understand how we should evaluate how these partnerships are like adding value to the company or to the business.
No, I don't think we look at it that way, though it's a very interesting perspective you've added. We are just looking at above market growth as a function of our own portfolio, function of partner portfolio, and driving strong volume growth. Volume growth may come out of some product families, not from all. Just the partnership angle, I don't think we're saying we will grow at par with market and then add the partnership revenues we get from others. It was difficult to split it that way. So our objective is to beat market growth, and I think the way to do that is to probably look at our own portfolio plus partner portfolio plus the volume growth.
Okay, just last question. If you look at it now, when we talk of lung leadership and organic growth and the amount of cash which we are generating, and if I divide it between three kinds of investment, one would be our own R&D in, as you mentioned, organic growth for Europe and US led by own products. Second would be the riskier assets, like where probably the investment would happen, but we don't know the exact outcomes. So outcome could be 0 or 1. and then the third is the distribution towards the shareholders. So how is the management thinking about how the investment buckets would fall in based on the incremental cash which the company would be generating? How should we understand how you are thinking about this allocation?
No, I think, maybe I can give a few statements that could help you. I understand where you're going from this thing. Our first priority is to drive a sustainable growth of our business. To that effect, we have created certain things. We would like to, we have mentioned that we will grow. Our attempt will be to grow both ROIC as well as our EBITDA in a certain range. And, though we are now feeling confident that EBITDA could continue to increase on the back of launch momentum, etc., we are also taking calls to invest back in the business. Because right now we would like to see the growth journey of this business to be sustained over a period of time. So, if the call is, can you do 25% EBITDA and 5% growth versus could you do 23.5 or 24 EBITDA and 10% growth, we are likely to fall back on getting more growth over the long term. So we are actively reinvesting back in the business. The second question is, you asked about R&D. We have generally given a guidance range that we will not expect our R&D in years where we have bulky and chunky R&D to be more than 7.5%. So we're very clear about how much money we will invest in R&D and where the focus will be to grow our top line. So these are two broad yardsticks that you could use. While our objective is to improve our EBITDA trajectory further, we are going to try and reinvest money back into the business to support growth. From a shareholder perspective, this is more the board decides. I think based on where they think depending on how we see our capital needs for the future and a benchmark performance of companies that we see in the market. And I think based on that, it's been probably our first 1.5 year of cash surplus. Dividend strategy is decided by the board in terms of how to return money back to the shareholders.
Sure, sir. I will return back to the board. Thanks.
Thank you.
Thank you. The next question is from the line of Damayanti Kerai from HSBC Securities and Capital Markets. Please go ahead.
Hi, thank you for the opportunity and congratulations on a good set of numbers. So my first question is on some of your key launches which you are expecting to come in, say, second half of next fiscal. So can you update us on the status of your filing for Abraxane and Advair? Because last quarter you mentioned you need to do some study for Abraxane. So maybe on these two key assets you can share some of updates.
Yeah, certainly. I think both we have seen. Advair, I had mentioned in our speech that we are waiting for the FDA. We are in correspondence with them, and I think we are waiting for the regular updates that come from them and questions with regards to our file. So I think that is on Advair. And on Abraxane, which is nano-paclitaxel, we are furnishing some more data to the FDA. Our belief is that the market could form in April with the first player's launch. But we believe that the nature of this product may not result in a total market formation because of the supply that both the innovator and some of the generic companies may face in order to satisfy the market. So we think this is a good asset for the long term, and the market will stay limited for a very long period of time. And we still have some, the FDA has asked us questions, and we still have some data that we are submitting to the FDA.
Okay, so very broadly, you remain on your, I'll say, earlier expected timeline of these launches in second half next fiscal. Should we work with that assumption?
Well, each launch is different. Both of these are different. But yes, we have guided that our second half of the year will have more launches compared to the first.
Okay. My second question is on Lenalidomide approval. So have you launched the product in market, and how many such peptide products you have in your pipeline?
So I can't give you the specific numbers, as I mentioned, we will try and Lenalidomide to build a sustainable share over the medium term. And right now, we are in the process of assessing the market, and there will be a launch correspondingly in this quarter, sooner rather than later.
Okay. And where this product will be manufactured?
We are not disclosing that, but it is at our partner site.
Okay, thank you. I'll get back in the queue.
Thank you.
Thank you. The next question is from the line of Prakash from Axis Capital. Please go ahead.
Yeah, hi, good evening, and thanks for the opportunity. My question is on the India business. Since we had a large, over 9 months, if you see there has been COVID contribution. How do we see this business for next year, given that, we are doing fairly well in our, base portfolio? Do we expect flattish performance or how do we look at it? And what is the COVID contribution for 9 months, please?
Kedar?
Yeah. So, Prakash, we are not disclosing specifically the COVID contribution for one specific business, but as I mentioned, from quarter 2 to quarter 3, there is a large decline at a company level in terms of the contribution. And depending upon how quarter 4 evolves, the number of cases evolve, I think that could get tweaked. Obviously, our responsibility is to service as much demand as we face in India and other markets. Vis-a-vis the next year, our thoughts are still being shaped by all these evolving developments. What we are happy is, and you would have seen that in our presentation, Prakash, is all the key therapies, respiratory, urology, cardio, overall chronic, acute. I think we are experiencing strong growth. So it would be tough for us to exclude COVID and talk only on non-COVID, because some part of COVID, in our view, might continue in the next year as well. So maybe in the May call, when we announce full year results, that may be a best time for us to give some clue into next year. But growth continues strong in RX business, GX business, and consumer health business.
Okay, perfect. Thank you for that elaborate answer.
And
my
Prakash,
second question...
Sorry, yes. Just to add, I think a couple of deals we had announced. I think maybe you should factor the contribution from some of these deals that we had announced in the past, which will get commercialized now, hereafter.
Okay, fair enough. And secondly, moving to R&D. So, the peptide approval that you got must be like 2-3 years, back, kind of R&D work you might have done. Trying to understand what is the next level of R&D work you are doing, which we will see approvals, filings over the next 2 to 5 years. So one is peptide, one is respiratory inhalation. What are the other areas we have already worked on, and what we plan to work for the next 2 to 5 years?
I don't think because I'm not sure we'll give this level of information. I can just say that on respiratory, of course, we will want to cover as many assets as we can. On some of the other injectable assets, there are, outside of peptides, there are different technology platforms around the release characteristics of this drug and the encapsulation of injectable products. Those are some of the things we will begin to build out. They are not easy technology platforms, and some of these may be partnered, some may be our own, and it will take us time to internalize this. So I think longer term, that is where we want to go, and I think we are working towards it. But it's quite a leap for us also to make in terms of getting there, and I think we are confident that with the right focus, we'll be able to do it.
When you say partnered, how do we see the financial aspect of it? I mean, these are just contract manufacturers, or these also have contribution in terms of funding and doing some trials?
Well, they could be both. Some of these could be early partnerships where the risk is largely taken by cipla. Some of these are in the nature of partnerships where cipla and the partner both take equal risk. And some are just basically manufacturing agreements. So I think it will be all three depending on the asset and our relative ability to do it ourselves versus the need to bring in a partner who has mastered the technical complexity of the asset.
Okay, perfect. And R&D we should build in 4 to 5% only, or do you think with these kind of more deals happening, etc.?
No, I think it will go up. It should go up. I think next year definitely we are penciling in a slightly higher R&D. Whatever it may be, it will never be higher than the 7 to 7.5% that we've set as a target for ourselves. So it will be slightly higher than this year.
Understood. Perfect. Thank you.
Thank you. The next question is from the line of Bharat Sheth from Quest Investment Advisors. Please go ahead.
Hi, congratulations Umang and Kedar on good set of numbers, and thanks for the opportunity. So my question is on One India play. So what is the really, where we are seeing the benefit of One India in say RX, GX and consumer? And second question is, now we have been seeing that several platform-based pharma launches are happening with trade generic. So how that will disrupt the whole trade generic business, and what are our strategy to make that kind of disruption?
Yeah, Kedar, do you want to take it first?
Yeah. So Bharatji, between prescription, generics and consumer healthcare business, I think the synergy exists on several counts. I think portfolio is one, supply chain and distribution is another. Some of the capabilities for campaigns, advertisements, ATL spends is third, and overall brand name and expertise in terms of digital analytics, that is fourth. So I think there are several angles, Bharatji, in which we could leverage, and we are leveraging between these three businesses. There is an active work stream which we have been speaking about for some of the brands which are in generics business, which have very high recall, and those are actually consumer brands. And those are being contributed heavily by CHL business, either through their own channel, modern trade, and in terms of approaching consumers, converting it to almost like a B2C kind of a brand. So some of this is already in the numbers, Bharatji, and we believe that going forward there is a very strong synergy across all these angles. We are particularly excited and interested on two counts. One is the consumerization, as I mentioned, and secondly the digital aspect. So digital analytics, reaching healthcare practitioners, reaching channel partners, analyzing brick by brick throughout the Indian demography and geography, and targeting specifically for a particular region, particular therapy. I think those are the avenues in which we are seeing an enormous power for all our three businesses. And obviously, as I said, I think the performance is in the current numbers as well, and we are hopeful that it will shape up to become a more dominant engine in the coming year.
Okay, and the several platform companies which are owned by large industry, and they are planning to launch several private labels. So how that can affect our trade generic business?
See, actually, we do have, we have been watching, all of us are watching some of these evolving developments in the e-pharmacy or other, be it teleconferencing or other avenues and platforms in which newer companies are reaching patients directly, not even channel partners. I think we are watching. We have our plans in mind. Some of those plans are being executed as we speak. In our view, I think the strength of the reputation, the corporate reputation, the strength of individual brands in all these three businesses, and the execution engine that we have built in is one hedge, for us to offset. And going forward, I think we have to deploy several strategies. It will be tough to enumerate today all of those, but we are conscious of that possibility of disruption, and we are working out for it.
Okay, thank you, and all the best.
Thanks.
Thank you. The next question is from the line of Anubhav Agarwal from Credit Suisse. Please go ahead.
Hi. Good evening, guys. First question on lanreotide. I'm just trying to understand this product. In general, how many new patients start on this lanreotide annually as a percentage of total patients? Can you give some rough idea?
Yeah, Anubhav, it's a little complicated, and I'll tell you why. There is a historical average which we have, but the historical average is also changing because there is octreotide, which also we have heard there will be generic competition on, and there have been some supply issues with octreotide in the market as well. So the two products at some points, overlap and interface for a few indications in the market, and I think that's the issue. Why we've seen that lanreotide growth has been high, and of course there's also been value growth that that every year innovators take on their portfolio. So it's a little difficult to estimate what are true new starts because of this mix. But we have a historical average, and of the total patient pool, I don't think the number of new starts is very significant from a lanreotide perspective. But it's right now the data is convoluted because of some amount of interface with octreotide.
But even just to get some idea, that historical number will be 10-20% or even less than that.
Yeah, I would think that ballpark you're in the right range. Maybe towards the lower aspect of the 10-20% number that you mentioned.
And would it be safe to assume that your ability to take market share on new starts will be very high, and existing guys may not shift to your product, and that's the reason you're guiding for a very, let's say, slower ramp up here?
Well, I'm not sure that we look at the market necessarily from the new and the old. I think we are also learning this market, and our objective is to build a sustainable share over a medium term. Sustainable from a perspective of what we can supply, as well as where we think this equation will hand out in the market. So yeah, I'm not sure that it will just be the division will only be new versus old, but it will be also guided by the way we can supply the market and how much we believe we can ramp up.
Okay. So, and just a couple of more questions on this. So, in terms of let's say going and talking to each of the hospitals, so will it be like just talking to some of the GPOs as like promoting a normal injectable product, or pushing a normal injectable product versus pushing lanreotide? Is there any difference, or is it the same thing, just going to GPO and being present there?
No, I think this is also a very significant clinic product, Anubhav. So I think it will be a mixture of the clinics and the GPOs. And the market, though even I think the market is generally for these fairly well established in terms of this. So I don't think the outreach is more significant than a conventional health system approach to the market. So I don't think it will require, if your question is that, would it require significantly more than the way you operate in the health system space today? No, it won't.
And in terms of the formulary coverage, so assuming typically generics get an advantage, but in this one, let's say when doctor is thinking about an existing patient, will he be incentivized enough, not by you, but let's work on the formulary PBMs perspective to, let's say, to use a generic versus the brand?
Well, I'm not sure we understand that part of the market that well, and I don't know whether that would work. I think our primary route would still be through the clinics and the GPOs.
Okay. And second question is, you mentioned about one of the complex injectable launch in fiscal 24 from a portfolio in your presentation. Just wanted to understand that broadly, can that be as meaningful as lanreotide, or in that stature, in terms of contribution?
You are referring to, Anubhav, our presentation?
Yes, which we made in mid of January.
With JPM?
Yes, correct.
Yeah. Yeah, I think lanreotide, because of the timing, is obviously because they're the only generic player. I think the connotation is different. I think that other product may have more competition than just us being alone in the market. But it's a question of timing. When we started lanreotide, we also thought we may not be the first to enter this market. So I think it depends on the number of competition, but it is a meaningful asset, maybe not as meaningful as lanreotide, but it is definitely meaningful.
Okay. Can I ask one more question on consumer wellness portfolio?
Please.
So you have transitioned certain products to Cipla Health. You already done 10, 12 products over there. But let's say some of the larger products which are yet to be transitioned, Omnigel, just as an example, what is stopping you from transferring this right now from GX to Cipla Health? That's one question. Second question is, and that's more general question, once a product is transferred from GX to, let's say, consumer portfolio, do you reduce channel discount because now you're putting more resources behind advertising it? Or let's say that's a more phased out process. At some point in time, you go ahead and reduce the discount to the channel margin. Can you just talk about these two things?
Yeah, I think so. Firstly, what's stopping us is, I don't think there's specifically anything stopping. The board is, today approved the scheme of through the slump sale. So I don't think there is anything stopping us. The question is, how do we grade this over a period of time, considering, the timing of the shift, as well as considering what we believe could be the impact on several other businesses that we run. Right. So one is the ability of the business we're transferring to, their ability to absorb it. The second would be the ability of the transferred business to see it, and the timing in the market on when is the right time to do it. So I think there's nothing stopping us. It's a function of how we grade the transfer. I think on the margin piece, I would just say that it's a mixture. It is product to product. Sometimes margin corrections happen overnight. Sometimes they happen over a period of time, depending on how much we think the equity of the product in the market is. And I think it's a function of both of these. But yes, the general trend is that you transfer, you kind of reduce margins, and you take up your advertising spend to create demand.
Thank you.
Thank you. The next question is from the line of Surya Patra from Phillip Capital. Please go ahead.
Congratulations for the good set of numbers, sir. And my first question is on the outlook FY25 or till the time the outlook that you have given for the US market, that you are saying that incrementally 300 to 500 million odd in revenue can be added annually. So by that, are we a bit more conservative, considering the potential of Revlimid and products like Advair? And so considering these two products' potential contribution itself, either we are a bit more conservative here, or we are anticipating larger than expected competition for Revlimid. So could you please clarify on this, sir?
Yeah, I think Kedar, maybe you can take this.
Yeah. Surya, we had spoken about these targets about a year back in the last year's January month. And from that vantage point, we had said there is a possibility of 300 to 500. Look, when you pan out future launches and multiple variables which will shape those launches and incremental growth in a market like US, over a 5-year time frame, you are going to be right for some assumptions, and you are probably not going to be right for some assumptions. So I think how competition would evolve, how pricing will evolve, how our ability to take share would increase in some pockets or not. See, I think all these factors depend and eventually will determine where you will get into it. We feel that 300 to 500 is ambitious enough because our base that time was around 500 or so when we spoke a year back. And as things stand today, we have progressed well. The early indicators are quite positive. Our ability to take share, our ability to service the needs of the market, our ability to seamlessly ensure supply chain and compete wherever we have to compete in case of additional competition. and most importantly, the development and regulatory engine. I think everything is working fine, Surya. Now, this is the 300 to 500 is a congregation of several assets. And some of those are filed, some of those are yet to be filed, some of those are quite ahead in the review process. So what we would not do probably is to attach any word whether conservative or not conservative. But what I'm just saying, the external business environment and our ability to respond to it would shape up this opportunity. In our view, it is ambitious enough. There is no conservatism in anything. We have internally for every launch, we take it very seriously and very meaningfully, and there is no conservatism. We go all out. What we avoid is getting very disruptive on pricing. I think our attempt is to be very responsible on pricing. So that's the only thing I would caveat. And yeah, that's it.
Yeah. Fine. And my second point, if you can just give some clarity about your China thought process. So how critical that could be for the in the overall revenue mix, how critical that could be, let's say, 3 years down the line?
Yeah, so projects, when you expand into new countries, and especially when there are multiple layers for approval and listings in hospitals and regions, and then several regulatory pathways of filing through local manufacturing or through Indian manufacturing. I think those plans often play out, Surya, over fairly long term. So, I mean, to answer your question from a 1 to 3 year standpoint, it may not be as meaningful. But we have the plant ready now, as you know, and the capability has been built in. The initial set of batches are being taken. We are excited because it's the second largest pharma market globally. So we are excited, and there is a lot of respiratory potential in that market. So we are excited, but to answer your specific question, from a 1 to 3 year standpoint, it may not be relevant. I think going forward, it would shape in the subsequent years to be probably meaningful for our emerging market franchise.
Sure, Kedar. Thank you. Thanks a lot.
Thanks, Surya.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 1 per participant. Should you have a follow-up question, we would request you to rejoin the question queue. The next question is from the line of Nithya Balasubramanian from Bernstein Research. Please go ahead.
Thank you and congratulations on another strong quarter. So I have a follow-up on lanreotide, and I'm going to squeeze in one more. So lanreotide, one is, given that it's a complex product and it's a relatively difficult manufacturing, is your partner geared up to, let's say, help you get like 20-25% of the market? Is the manufacturing ready? 2, given that you're not a therapeutically equivalent product, what incremental commercial infrastructure investment will this product require? And the next one is actually on expenses. So excluding R&D, your expenses seems to be trending down. Should we assume that 3Q was largely a normal quarter in terms of India, sales force, expenses, etc.? Is this the new normal?
Maybe can I request Kedar to take on the third one first, and then maybe Nithya, I'll come back to answer the first 2.
Yes. So I think most part of the quarter, Nithya, the large part of the field force was in operation. And as we keep saying, our attempt was to secure and safeguard some of the efficiencies that we delivered last year through reimagination exercises and some of the digital initiatives. So I think some of those seem to be working. And I mean, business model across the regions and at the overall company level is fairly optimal now. Although, we still feel there are some opportunities to execute. So given all of this, I think you should treat quarter 3 as a base, and subsequent to, as you know, that we have often said, a large part of our OPEX is very responsive to the sales in multiple geographies based upon the commission, discount, and other arrangements that we have. So I think the expenses would respond to the sales volume and value. But overall, I think you should treat Q3 as a base quarter, Nithya.
Got it. Thank you.
Thanks.
Thank you.
Yeah, and Nithya, there are 2 more questions she's asked. I think the second one that you asked was on whether we believe there's an incremental amount of infrastructure required to drive this, and our understanding of the market right now is no. Our current infrastructure will drive it. The first question was on the capacity, etc. Look, I think the partner that we have is also a partner that understands this product well. And we have a certain internal target of where we want to get, and I think the partner is geared up to supply to that target. And we've guided it will be sustainable over a midterm basis.
All right. Thank you, Umang and Kedar, and all the best.
Thank you.
Thank you. The next question is from the line of Samir Baisiwala from Morgan Stanley. Please go ahead.
Hey, thanks, and good evening, everyone. I think even I need to ask you questions on lanreotide. So here I go. So, Umang, can you just share how is the product different from the innovator that you had to take 505(b)(2) route? And second is, you mentioned, sustainable market share or midterm. But if I just have to have some inkling, so are you looking at double-digit market share, say by exit market share by end of next year fiscal? Is that realistic?
And what is the? So Samir, let me mention. I think we will not divulge information on the specific targets for share, etc. All I can say is that as I mentioned, will be whatever is sustainable over a medium term. I think that's where we'll go, because I think at this point the product is also competitive in the marketplace, and we don't want to divulge too much of information on it. The first part on how the product is different, I think we can have a separate discussion. We're happy to provide that visibility to you. But it's largely around, things we have used to offset the patents, etc. that at one time were on the product.
Okay. Umang, just is your device ready to use, or is it needle assembled?
The device. What do you mean by ready to use, Samir?
So that's the new form that the innovator has transitioned to, where you don't need to assemble the needle with the while injecting.
Yeah.
The older form.
We are in that manner. We are ready to use.
Okay.
So, sorry, can you go back and tell me what was your earlier thing? So the innovator is. So your question is, are we? So we are not. There is no need of. There is no need of mixing any diluent or anything into the product, if that's the question you're raising. If you're saying does the needle have to be affixed on the product, yes, the needle has to be affixed on the product.
Okay, got it. Versus, I think, the innovator device where that you don't need to. So that's a bit different.
Yeah, they have changed some part of that device in the past as well, and that is correct. That right now they are all pre-assembled. The ready-to-use connotation is actually a little different in the injectable space, which is why I asked you what you meant, because generally RTUs are more no need of diluent, no need of anything else within the clinic setting. So that's why assembly-wise, we need to assemble. I'm told the innovator product is pre-assembled.
Okay, no, that's fair enough, Umang. And but I mean, keeping the semantics aside, does the device difference makes a difference, from the commercialization of the product?
We believe not, Samir, but I think it is a function of acceptability of the product in the market. So we don't think so, but that is out of our experience so far in this area of the market. And I think as we begin to understand the market more and launch in the market, there will be more information. But right now our assumption is no.
Okay. And just one final on this, Umang, that I know you can't say much, but what's the commercial arrangement between you and your partner? Is it like more or less the industry standard 50-50 profit share plus or minus, or is it very different from that?
Well, I could say broadly we are there, but there are some nuances here. So broadly.
Okay. Just one final question with your permission, if I may. I saw that you filed for 2 respiratory products in Europe. So just broadly taking 3 or 4 year view, how do you compare the respiratory opportunity in Europe versus the US in terms of addressable market and the competitive dynamics? Is it, if you make $100 in US, would you make 20, 30 in Europe or much more than that?
Samir, it's again a function of our market entry. I think Europe is more sensitive to market entry than the US is on these products. So in the US, if you are even third or fourth player, because of the volumes in the market and people can carve out their own shares and stay sustainable. So albuterol, for example, has so many people who have launched into the market, but the market is still attractive for many players. Whereas in Europe, I think that equation changes very rapidly after the second or third entrant. I think the market begins to be more responsive on price than we've seen in the US. So yes, I think the Europe potential is significantly lower compared to the US, but it depends on your market entry and your timing. So if you're number 2 or number 3 in Europe, I think it can still be an asset which could well be 20-30% of the US, like you mentioned.
Okay, great. Thank you so much and all the very best.
Thank you.
Thank you. The next question is from the line of Neha Manpuria from Bank of America. Please go ahead.
Thanks for taking my question. Umang, we had the investment in Avenue, which obviously we have terminated. But I think that investment still continues. In a lot of your presentations and of late, when it comes to the US business, we've talked about, respiratory and injectable largely being the areas that we're investing in. So is it fair to assume that specialty is something that we're not looking at? It's completely out of question, or do you think that is still open and you will explore that based on what opportunities come your way?
Yeah, Neha, I think on the specialty part, the Pulmotrix asset, which is a respiratory, antifungal, inhaled antifungal asset for aspergillosis, that is continuing on its path. We continue to sell plasmomycin in the US. It was intended to be our second asset after the tramadol asset from Avenue. And I think Avenue, unfortunately, the asset has not progressed forward. So specialty, the strategy is always built around an asset, a central asset.
Yeah.
And now plasmomycin is taking the load for everything. And the asset, plasmomycin was never intended to be a big asset. So we are discussing strategically. In the absence, let's say, in the case that tramadol does not go ahead any further as an asset. Anyway, our rights to tramadol have ceased. We are now only an equity investor. So if we don't have tramadol in our portfolio, then there has to be some amount of rethink on what we do with plasmomycin and what would be the asset that would come in its place. So we're actively in discussion on this. But the asset on the respiratory space, which is the inhaled antifungal, that is proceeding in its clinics, it's proceeding ahead with the partner.
Okay, so just to understand this correctly, we are looking at opportunities, and depending on what comes our way, we'll decide whether we would like to invest further in that business or not, assuming tramadol does not happen.
Yes, assuming tramadol does not happen, we will need to find a lead asset because Zendri is not a lead asset, right? It's a smaller niche asset. And it can't take the load of the whole portfolio. So that is the stage we are in with respect to those 2 assets. But the respiratory asset that we have, that is in the clinic and it's going on.
Understood. And when we're looking at these opportunities, is there, for example, we already have one respiratory asset. Tramadol was more a pain asset, but it was a fairly large opportunity. How are we thinking about what opportunities we could look at? I mean, is it fair to assume it would be a tramadol type opportunity which might not necessarily require a large commercial footprint?
No, I think we don't want to invest too much money on huge commercial footprints. I think that we're clear about. But one of the things we've also gone back and tried to tried to tweak and change, and we are actually in the middle of that, is that we must have our own, some pipeline assets that come from our own labs. They may be small. They may be 30 million or 40 million in size, or 20 million, or between 20 to 50 million in size. But what happens is when you have the disappointment, when you have an asset that does not come, or the asset disappoints in a late phase 3 trial, you have the ability to at least cover it up with something that is within your stable, right? So when we did tramadol, etc., we didn't have this pipeline backing, right? And now, we are at a point where in about a year and a half, 2 years, we might have at least some of these assets close to filing. They may not be big, but at least they add the portfolio weight and momentum for our specialty journey.
Understood. And sorry, one other question on the India business. If given that we're talking about entering into new categories, you talked about anti-diabetic and injectable in your opening remark and even in a recent presentation. So is it fair to understand that, the penetration level of our existing brands, is getting slower, and therefore we need more such, launches and probably these partnered products to, maintain the strong momentum that we've started seeing in India? Is that one of the changes, or am I reading that incorrectly?
I think it's both, Neha, because really there is no product source unless you partner with an innovator, right? I think the days where you could do, a changed formulation or the addition of an excipient and relaunch the formulation, those days are there, but realistically the bang that you get out of that is now much lesser. So if you really want to bring more products and more innovative products into the, more products which are patent protected and innovation driven, you have to partner with the multinational corporations, is my view, because there's no other way to get innovation into India. So it's a mix of both. It gives us growth, and it certainly is driving growth for us, but it's also, in my view, an absolute necessity. Because why would, for example, yesterday there was news that Novo Nordisk is launching the oral semaglutide in the market in India right now. That's it's a great product, right? Now, if it was not Novo themselves, and supposing Novo was looking for a partner, many Indian companies would have offered the partnership for this. Because the therapy is a game changer, right? So why would anyone sit out when there is innovation that we can bring to this market, which can spur the market growth and create, an unmet need demand?
In that case, the fact that we need to get more such partner products and that we're launching new divisions, which would probably require investment in, expanding our MR coverage, would that mean that, incremental growth in India is coming at lower margins?
I think to some extent you could say that, because the partner also shares here, right, in the thing. But I think what is changing is, Neha, there's a very active reallocation of capital that's happening across India by all the Indian companies. And I think what that reallocation of capital is doing is that it's taking capital and putting it, around the assets and the brands that you want to create formidable franchises with. So what happens is, I don't think the infrastructure requirements of launching products from innovators is anything new for the top 10 or 15 Indian companies, because everyone will have a cardiac field force, everyone will have a diabetic field force. And every time there's a new product that comes in, I think they kind of eliminate the tail. All of us eliminate the tail of products that we are selling currently, so that productivity is maintained.
Understood. Thank you so much, Umang.
Thank you.
Thank you. The next question is from the line of Tushar Manudhane from Motilal Oswal Financial Services. Please go ahead.
Yeah, thanks for the opportunity. So just would like to understand again on the India part, like how is the profitability now in terms of the branded prescription and consumer health and trade generics? Either in terms of the pecking order or maybe a broad range, if you could highlight.
See, Tushar, more or less, prescription business and generics business profitability was close to each other, although not equal. So prescription business is a bit higher than generics business. Both are convincingly higher than the company, EBITDA. And consumer business, as you know, will reach break-even fast with the current state of portfolio, which means what? Which means the earlier launched products are break-even and in fact generating significant money, which funds the subsequent launches. So I think that engine is working well, Tushar.
Got it. And lastly, also maybe for 9 months or for 3 months, if you could break down this India business proportion into branded trade and consumer health.
I can come back to you separately. Tushar, I can come back to you separately on that.
Okay, sir. That's it from me.
Thank you. Ladies and gentlemen, that was the last question. I would now like to hand the conference over to Mr. Naveen for closing comments. Thank you, and over to you, sir.
Thank you so much, Faisal. Thank you everyone for joining us today for our Q3 earnings call. In case you have any follow-on questions, please feel free to reach out to either myself or Ankit or write to us at investor.relations@cipla.com. Have a good evening ahead. Thank you so much for joining.
Thank you. Ladies and gentlemen,